Okay, so we're officially recording, Holly,
Okay,
and
perfect.
we have 1 minute before 11, so we're just going to wait for people to sign on. And as people are signing on, just know we're going to probably start about 11:02, just to give everybody enough time to log on. And we promise we won't keep you more than 30 minutes. We'll probably be out a little bit early and give you time back in your day. So just stay tuned. We're going to give everyone some time to log on.
Yes, absolutely.
So
Elise,
what are your plans for 4th of July, Holly?
okay, well, I'm headed to Mexico pretty soon. So I'll
Oh,
be back almost right in time for 4th of July.
that'll be awesome. Is it
Well, I
going to
have
be
no
hot in
plans.
Mexico?
I'm going to the beach, so probably, but I'm gonna have some water.
Get your tan going. It's
I
time.
know, I need to. I lost my baseball tan that I had from watching my son all the time. So okay, for those of you that are just logging on, welcome to Let's Talk Money, honey. We'll be beginning here in just a few minutes. We're going to give a few more people time to just log on, and we want to make sure that everybody gets logged on before we get started. Be sure to grab a pen and paper to take plenty of notes. If you have questions during the presentation, be sure and write them down. Due to compliance issues, we are not able to have a chat Q&A or even really a verbal Q&A. So what we're going to be able to provide is just our contact information, which is going to be contact information for our social media, contact information for our phone, texting. You can contact us in various different ways. And I would just recommend you reaching out to us with your questions, and we will be happy to go over them one by one.
Definitely. Okay, so we're getting to almost time to start. It's 11:01. So like Holly said, grab a piece of paper to take some notes. If you have any questions, email us. We definitely want to hear from you. We love hearing from you guys. So Holly, take it away. Let's get started.
Okay. So we just want to welcome everyone to the second session of Let's Talk Money, honey. Our intention with this webinar series is to help women become more active in the world of investing and be a resource for anyone that is looking to learn. With that being said, we realized after our first session on being intentional with your finances, we've got to start at the very beginning, and we've got to cover the basics of investing itself. And so that's why we're here today. We're just going over some basic definitions and what it means to just invest. And we're just going to focus on the fundamentals. So Elise, let's dive in.
All right, so let's quickly introduce ourselves before we get started. For those of you who don't know me, I'm Elise Levy, and I'm based in Reno, Nevada. I learned after spending many years working in the field of marketing that I really wanted to find a job where I was helping people and making a real difference in their lives. So now I get the pleasure to work with my dad and my partner, Mark Levy, at Legacy Wealth Planning, where I am inspired every day by our clients. I love getting the chance to help them reach their retirement goals and dreams and get to know them along the way.
So I'm Holly Henry. I am out of Hatfield, Arkansas. Not only am I a financial advisor, but I'm also an owner of a few small businesses. And I'm the mother of two wonderful kids, Ryan and Ace. Professionally, I work for River Valley Wealth Management. Tim Cleveland is the president of the company, and we have two offices. So one is located in Paris, Arkansas, and the other one is located in the Hatfield area. And I just am absolutely honored and thrilled to be able to have this job. It is a challenging job, but most importantly, I just love to be able to help people financially with their questions and empower those that are around me.
Totally. And I just want to throw this in here because I think some people might wonder how Holly and I even know each other.
It is so
If you
true.
haven't noticed,
So
I'm
true.
from Nevada and she's from Arkansas, but we actually went through the same training program to become financial advisors. And we really bonded over that we both really want this role and this job to help motivate other women to take control of their finances. And we both feel very motivated by that vision. And that's kind of like how we started working together and creating this whole webinar series where we get to educate people for free. So just wanted to share that.
Yes, absolutely. I'm glad that you did. Okay, so one of the important things that you are going to need to know is is what's the difference between active income and passive income? And the best way to describe active money is this is money that you have to work for. So the best example and the easy example is your day-to-day job. You have to go to work to earn that money. Passive income is money that is made without having to work for it. How many of you have heard that phrase, have your money make your money? And that's exactly what passive income is. It's money that can be made while you're sleeping. And then there's also this nice category that's kind of a blend of active income and passive income, which a great example of that is rent houses. So for the most part, a rent house is passive income. You're not having to do a lot. It's kind of self-managed, but every once in a while something breaks and you have to go to work on it. And then it becomes a little bit of an active income. So again, a nice blend of active and passive income is a rent house.
All righty. So what type of accounts offer the passive income that Holly was talking about? So there's many different kinds, and how we kind of categorize them is we look at what kind of money is going into the account. So what I mean by that is it after tax dollars or before tax dollars? So your traditional IRA or individual retirement account or any retirement plan that you have through your work is made up of pre-tax dollars. So that means your contributions are coming right off of your paycheck, and then the money in that account is going to grow tax deferred. What's the catch to that? Well, since you don't pay tax at the beginning, you will have to pay tax when you take the money out. The idea is when you're taking the money out at retirement, you're not going to be working, so you'll have a really low income level. So hopefully your taxes will be low as well when you pull that money out. A Roth IRA is another retirement account option, but it's actually made of after-tax dollars because it's a very optional additional savings effort that you elect to do, you aren't required to do. So similar to an IRA, you're not taxed on gains that the account makes. You're just going to have after-tax contributions. And then when you pull the money out, since you've already paid taxes, you get that money tax-free. So that's a great supplemental option. So the other option is a non-retirement account, but it has a lot less perks. So they're made up of after-tax dollars, but you will be taxed on capital gains. There are two types of capital gains you should be aware of. There's short-term and long-term. Short-term is owning and selling a stock or a mutual fund or whatever product it is, and then selling it before a year. After a year and a day, it becomes a long-term gain. Why does this matter? Long-term gains are taxed at a significantly lower level. So that's why when we advise you, we try to always make sure you're doing a long-term gain and holding that product at least a year and a day.
Yeah, and I also want to throw in when we're talking about stuff like different types of accounts, we don't expect you as the client to have any idea what type of account that you need. Like we expect you to come in and talk to us about your financial goals and what you hope that your money does. And then we will provide you with what we feel like is the best type of account to fit those needs. So again, don't feel like you need to memorize any of this. We're just wanting to educate you on what the different types of options are.
Totally. And I think like most young people are going to come in with their retirement account through their work. And then we're going to suggest all these different supplemental things that are going to help you achieve your financial goals. Because the truth is just that retirement through your work, it's not going to be enough to have the lifestyle that you probably want in retirement and the lifestyle you probably want right now. So that's where we come in, and we know everything and we have it memorized, so we can suggest the right stuff.
Okay, so even though there's various different types of accounts, they can even then be further broken down into a brokerage type of account and advisory type account. And what does that mean? And these are two different types of accounts that are offered through our services. One type of account is called brokerage, and typically this is around $45 a year. However, the client will pay for any type of buy, sell of investment products throughout the year. This type of account is pretty self-managed. If someone is wanting to buy and sell products, they let us know. We don't go in and manage the money for them. I mean, we offer them our opinions and we try to help advise, but in the end, the client is making all the big decisions and the timing of it. The other type of account is an advisory account, and this is where we do step in as a financial advisor and we play a much larger role in this. To put it simply, we pretty well take over the account and we manage it the way that best fits the client's financial goals. So you pay a designated percentage of the assets under management, which is typically 1%. However, there isn't any other fees that are added, such as buying and selling of stocks. It's all covered under the 1%. And this type of account requires at least an annual review with the client. And I will say some people get very hesitant when they hear the percentage of that may be charged to them. But if a client is doing a lot of buying and selling of stocks, in the end, an advisory account may end up being the least expensive way to go. And again, we go over all the options with the client and they get to decide which way that they want to go.
Definitely. And I think that fee-based account is really a great option for people who aren't super involved in the actual buying and selling of stocks and know what products they're really passionate about. So if you're the kind of person who doesn't want to look at your account every day and kind of wants to have it be sitting there, peace of mind, taken care of by Holly and I, that's a good option for you. And it allows you to have peace of mind, know that it's actively managed, but that you don't have to go in and make all of these big decisions all the time. So it's a really good product, especially as you're growing your accounts in the beginning years, because you know it's properly invested for you. All righty. So now just to start going over some terms that you've probably heard of before, but we're really going to explain them in better detail. So the first product I want to talk about is stocks. So that's when you actually own a bit of a company, such as Walmart, Apple, Microsoft. So you're actually a stockholder and you have a stake in that actual company.
The next product is going to be bonds. And again, this is a term that you're probably familiar with. So a bond is a fixed income instrument that represents a loan that is made by an investor to a borrower, usually corporate or governmental. You see this a lot with municipalities. And it's just a great way for these entities to raise money to complete the projects that they're needing. And again, basically you would loan them the money through a bond and they would pay you an interest rate.
So mutual funds. This is actually a company will come in and it'll pool money from many investors and they'll invest that money in securities such as stocks, bonds, short-term debt, whatever they want to invest in. But that company is in charge of making all those decisions and they manage it and direct that. And you just own a part of that fund.
The next product is ETFs. And this is an exchange traded fund. An ETF is a type of security that involves a collection of securities such as stocks. And normally they track the underlying index. A lot of people are not as familiar with ETFs, but again, pretty similar with how mutual funds function too.
And one thing about ETFs in comparison to mutual funds is they're a lot cheaper. So mutual funds can cost they can cost almost up to 1% sometimes and sometimes over. And ETFs are usually a very small percentage of that. So 0.03% or something as low as that number. So they're a much cheaper option. The next one on the list is CDs, which is certificates of deposit. If you've been listening to the news lately and interest rates, CDs have gone way up this year. And they're a very safe investment, and it's a great way to get money back on your return. And what's great about them, and when I say safe, it's because the FDIC insures them up to $250,000. So if a bank goes out of business, like we've seen has happened this year, if your money is in a CD with that bank up to $250,000, you're going to get it back right away. So you have that no risk of losing your money unless you go over that amount of money that you're investing. So it really functions like a savings account and it holds a fixed amount of money for a fixed period of time and pays a very specific percentage, like 5%.
So the last product is an annuity. And it is simply put, a fixed sum of money paid to someone each year, typically for the rest of their lives. And there is a time and a place for an annuity, but we have to be so careful when we recommend them because typically an annuity can lock up your money at least 10 years. And if you want to pull money out, you're hitting surrender fees. So again, there's a very specific time and place that we would ever recommend these. And some of the situations that an annuity would be good for is a I can't spit that out. Not even trying anymore.
We're trying so hard to be perfect, and then we
I
say
know, and then I can't say that. Or someone that just needs a specific designated amount of money each year. And so again, there are good reasons to use an annuity, but we have to be probably even more careful when we recommend that over some of our other products.
Definitely. Okay, so another big takeaway we want to talk about today is not only these products that are available to you, but time, because time at the end of the day is your most powerful weapon to save money. So if we look over here, we're looking at saving $500,000 by age 65. And you see, the later you start, the more money you have to contribute, and it gets harder. So imagine putting away $142 every month. That doesn't seem that horrible to me. But if I have to put away $2,000 a month, that becomes really difficult, and it really changes your quality of life, how you're spending money. So you can see the earlier you start, the easier it is and the more you can save. So that's why it's really important to talk to Holly or I or another financial advisor, because it just gets harder and harder the later you get in life. And that doesn't mean it's not doable. If you're looking at this and you're older and you're wondering how to save for retirement, we can help you. We can make that happen. But we need to be aggressive and we need to start now. And it's really a true saying, the best day to start investing is today.
Yeah, and I do want to echo that. I think that this is important to share with anyone that you know that are in their 20s. Kids, daughter, granddaughter, whatever. A lot of people just are not aware of what the difference of time can make. So I think it's important. One of the reasons that we're doing this is to help spread the message, but it takes everyone listening to help spread the message too. And so if there is anyone that you can think of that needs to hear this, you let us know and we will gladly pass the information on. I mean, the numbers are there. It is proven that the longer that you're in the market, the compound interest, I mean, it's worth it for people to start in their 20s if they can.
It is. And it's a motivator, because once you see it working, then you get more motivated to put more and more in. And so even if today you're like, well, I really can only do $25 a month to start saving for retirement or a house or whatever it is, that's going to make a big difference. And you should feel encouraged to do whatever you can. And you'll see the power of it over time.
Okay, so we are going to talk for just a second about time in the market and not timing the market, because this is a conversation that Elise and I have with clients and prospects on a very, very regular basis. So if you look at this picture, it dictates the importance of time in the market and not time in the market. And I'm just going to let you know that even the best traders have not figured out how to time the market. And so if they can't figure it out, I don't feel like even people like Elise and I or the casual investor can come in and figure it out. So, but one thing that I always remind everyone, and it's this wonderful quote that I have, and it is just, it's basically a question. Do you know that the S&P 500 index's annual return for the past 30 years was 7.7%? But if you missed investing in just 2 of the best days in each year, then your return would only be 1%. And I feel like this just explains simply why it's important to stay in the market. So at a time right now when the market is very volatile and people are seeing their accounts go up and down, some days are green, some days are red, it can seem really scary and uncertain, and it feels like you're losing more money sometimes than what you're gaining. However, this is why it's important for you to reach out to Elise and I, and us to just keep you calm and develop a financial plan. And you stick with that financial plan. You stick with your long-term goals. Don't let what's right in front of you scare you out of the market, and then you end up losing what you could have profited because you jumped out.
Totally. And I just want to reiterate what Holly said. So when she said 7.7%, that's annual. Okay, that's not total. So they're making 7.7% return on their money every single year. Okay, that's pretty impressive. Okay, so we're going to talk about compound interest, which Holly mentioned. And we're really hammering this down because I think that just a person off the street doesn't realize the power of the stock market and what it can really do for you long term. So we're going to look at these two examples. Let me introduce my two friends, Mary and Christine. I'll start with the first person. We'll call her Christine. So she's going to invest $100 a month for 20 years. She's going to start at the age of 47. So she's the dark brown line, assuming an 8% annual return compounded monthly. When she's 67, her investment, which is $24,000, is going to be worth $59,295. Okay, so that's impressive. It made money, it made return. It's more than the 24 she invested. Great. So we're going to now move on to her friend Mary. She's going to do the exact same thing with one difference. She's going to start her 20-year investment period at 27 and stop when she's 47. So how much is her investment worth at 67? $471,000. That's the power of compound interest that we're talking about. By allowing more time for her investment to accumulate return, she grew her money 19 times her original investment. So just take a moment and let that sink in.
And I'm also going to throw in, Elise and I did a video through Instagram and Facebook a few weeks ago that talked about if you're a business owner, what it'd be like if you open up basically a Roth IRA for your kids. If you take the business, pay the kids. Anyways, you can go through it. But what would it be like for children if they start investing at 7 years old, at 10 years old, at 15 years old? So for those of you that are parents that want to really just give your children a head start, you need to go back and find that video. And I think I may have it pinned, but if I don't, reach out to me and I'll gladly send it to you, because the numbers on that, again, it blew my mind when I put pen and pencil to it. And it is another great example of this compound interest.
Totally. Thanks for bringing that up, Holly. All right. So this is a good rule of thumb when you're thinking about investing, and it's called the rule of 72. And it's basically looking at how long will it take for you to double your investment. So let's say you have $10,000 and we want to know how long it takes to invest to double that investment. So we're going to take what the stock market averages on a yearly basis, which is 10% a year for the last 100 years. And so with that in mind, we take 72 and we divide it by 10. And so we're assuming that this money is going to be 100% invested in the stock market, no bonds, nothing like that. And we're going to see that that money doubles in 7.2 years. And in 14.4 years, we'll see that it's worth 40,000. And that's without putting in any monthly contributions. But I think it's just a good rule of thumb to keep in the back of your mind when you're thinking about investing, because you're like, how long will it take for me to double this amount of money? And it kind of gives you perspective that you need to stay in it for the long haul, but it is very doable. And, you know, who doesn't have 7 years to double their money?
Okay, so we talked about the importance of having a financial plan and following the financial plan, but some of you may not even know what that even entails or what it even looks like. So we wanted to just show you just a few graphs. And I'm going to be honest, if you actually do a full financial plan, it's several pages that we go over. We just wanted to pull just a few charts. And so this slideshow shows a few examples of what it is included in a financial plan, which typically includes, like I mentioned, several pages worth of data that we go over with you in detail. You always get a balance sheet that shows your net worth and how your assets are allocated. The top right picture actually shows what your portfolio will be valued over a lifetime. And that takes into consideration at what age do you decide to retire. And the final chart shows where the money will be received. So whether this will be salary, whether it'll be Social Security, but it also takes into consideration any withdrawals that are taken out. So financial plans, one of the main things that is why they're so vital is they answer the questions that we get on a regular basis. And that is, how much money can I withdraw at retirement and still not run out of money before I pass away? And so we try to answer these questions for you. It's really important for you not to try and answer these questions yourself. It's good to have a professional just to step in and guide you. To be honest, these plans, they typically cost between $2,000 to $4,000 to create. However, for Elise and I, this is something that we do with all of our clients, whether it's an advisory account, whether it's a simple brokerage account. We want to make sure that our clients are comfortable in their financial planning. So the cost of what the financial plans typically are, it doesn't mean anything to us. Like I said, we are in this to help our clients, however, the best way that we can.
Totally. And I just want to add, the cash flow part is so great for people who are about like 5 years before retirement. But if you're a young person, you're like, why do I need to look at that? We tailor it to whatever your needs are and whatever we need to look at. So we have all these different options. And if you're young, there's a lot of benefits to looking at, your balance sheet and what's coming in every month, what we can maybe be saving more. And we can run all these scenarios and show you what happens when you invest just a little bit more a month and how that kind of changes over the long term. So it's useful for everyone at every age.
Yeah, and I will say that one of the reasons why I've used this for a younger couple here recently is they're in their late 20s and they don't want to work to full retirement age. So their goal is 55. And they know that they will not be able to tap into the retirement accounts at 55. So you got to figure out a way to bridge the gap, and they need to know how much money to start putting back. So again, this is another wonderful scenario that we come in and we develop these financial plans to help meet your goals.
Totally. That's awesome, Holly. All right. So what's next? Well, you're going to continue watching our webinars, but if you really want to get productive, you're going to have a discovery meeting with Holly or myself. And this discovery meeting is 1 hour long usually, and we'll meet with you with no cost and no commitments. So meeting with a financial advisor, you don't owe them anything until you bring them an account or sign a contract. So unless your pen's out, you're not going to be paying any money to meet with us. And we offer this over virtual Zoom. We work with people all over the US. I think like my last 3 clients have not been in Nevada. It's pretty hysterical. And we also meet in person if you do live in our town and you want to have that face-to-face interaction. But this is just an opportunity where you bring in all of your statements, your paycheck, and we just talk about money. And even if you don't end up working with us, it's a really good practice for you to just get comfortable talking about your money, kind of see the whole picture and understand where you should go from here. So at whatever age you're at, if you're 22, if you're 42, this is a really great exercise for you to do. And then we look at what are the right accounts for you to be investing in. So maybe you have one from a past employer that you haven't dealt with. We can help you deal with that. We can increase your retirement savings by opening additional accounts, or we can help with a side project that's not retirement, like saving for a house, saving for a rental property you want to manage, anything like that. And then once you do start working with us, we love to stay in touch. You're probably going to get sick of hearing from us because we're going to call you and we're going to text you and we're going to let you know how your accounts are doing. And really, we see ourselves as your CFO. So we want to take the stress away from you. So you're not fighting with your spouse about money anymore. And you can call us and you can have those conversations.
Absolutely. I think that is key, is that it is important for you to trust your financial advisor and to maintain a relationship with them, because we understand that we are managing probably one of your most important assets. And so we always are open for you to contact us. And again, we always try and make it easy, whether through email, text, so social media. So we're not hard to get in touch with.
No, we're not. All right. Speaking of which,
Speaking of which, there are several different ways to contact us. So be sure to follow us on social media. We would love to get to know you. We both have business Facebook pages. We have business Instagram. We're on LinkedIn. If you have any questions you didn't get to ask today, you can reach out over the email, or you can DM us again through social media, whatever is just easiest for you. We would love to be able to talk to you further. However, I do want to be clear that that's not the reason that we're here. The reason we are here is just to educate you and get you interested in investing. So even if we never hear from you again, if you get something from this webinar that just get your curiosity going on investing, then we've done our part. But we are also here just to be your cheerleader. So even if you're not to a place to where you're comfortable opening an account and you just have some questions that you want answered and you just don't know where to start, again, Elise and I don't feel like we can stress it enough that we're just here to help. We want people to just be the best version of themselves. So if we can do anything to help with that, then we're all in. And then the final thing that I do want to mention is that Elise and I pair up with our amazing friend Larry, and we have a wonderful podcast series and we have YouTube videos, and both of these are called Investing Advice Roundtable. And it just contains a lot of good financial advice, tips and tricks. So be sure and check them out. See if there's anything that can help you out even further.
Yes, and I just want to throw in, not only if you have questions, but if you have like a topic that you would like us to cover in the future, let us know, because we always love to hear from our audience, because you guys are the ones on the ground living with the real questions. And so we just want to cover information that is relevant and exciting to you guys.
Absolutely.
Okay, so these are our disclosures that we have to do. Because Holly and I are both licensed through FINRA and the SEC, just so you know. You can look us up on BrokerCheck, and that will have all our disclosures as well. And we thank you so much for attending this webinar. I hope you learned something in this brief half hour. And check your email for the remainder of 2023. We're going to have more webinars, and just stay tuned and stay in touch. Thank you so much.
Absolutely. Thank you.
All righty.